We do begin, though, with our talk of the tape, the road ahead for the biggest and most popular stock in this market, that, of course, Apple. It's bounced 19% off its recent low. The question is, can that momentum continue? Let's ask Erik Woodring. He is Morgan Stanley's Apple analyst, the executive director of the firm's equity research department. Rarely does TV, but as you can see, he is today, and we are glad to have you. Welcome.
Thank you, Scott.
You know, it's been a nice move, obviously, off of the recent low. What is your outlook ahead for the stock in, a new month that is on our doorstep as we sit, really, as I said, between the 52-week low and the 52-week high?
You know, it's an interesting period to be an Apple analyst here, Scott. Clearly, what we see in the market today is consumer challenges when it comes to electronic spending, right? We're coming off of 2 years of record growth. There is some digestion going on, but again, Apple is one of the companies has industry-leading loyalty rates, very low churn. You can gain confidence that people are going to come back and buy iPhones. So as I look out over the next 12 months, I actually see a fairly robust catalyst path, whether that's the launch of new AR/VR glasses this summer, whether it's the launch of the iPhone 15, where we think there is pent-up demand given some of the challenges that we've seen over the last, let's call it 6 months. The other part I'd say is Apple has guided to a decade-high gross margin. That cannot be lost upon investors. And you add this up, and with the last factor being services reaccelerating, and I actually think you're checking a number of different boxes that get me excited about the next 12 months as an Apple analyst.
So I love the fact that you brought up what's happening in the services area of the business, which obviously is so critical to moving forward. You use the word reaccelerating because you really have had sequential declines in that part of the business. You had an incremental tick higher in Q1 of this year versus Q4 of last. But there seem to be real questions, particularly around the App Store and what a slowdown in revenue there means to the overall services business. So how do you square that?
So the App Store is, call it 33% of services revenue today. It has slowed. I would categorize the App Store as kind of a COVID beneficiary. We were at home, we were downloading new apps, we needed to keep ourselves entertained while we were at home. We're now seeing the other side of that. We're digesting that spend. I don't think the app economy is broken. Of course, we all spend more time on our phone. We continue to download and use our phone more than we ever have before. That's a good long-term driver. But ultimately, right now, quarter to date, we see the App Store growing at about 0.5%, maybe 1%. So it's not necessarily robust, but you have to also consider over the last 6 months, Apple and specifically the services business has faced, call it anywhere from 5 to 7 points of FX headwinds. So I'd actually argue that on a constant currency basis, the services business is growing low double digits relative to what we think would be kind of a mid-teens constant currency growth rate over the next 3 years. So it's been challenging. The services business has slowed, but we don't necessarily think the underlying drivers of the services business are structurally challenged. And again, as you get further out into the year, FX does become a tailwind. Services maybe App Store maybe slightly reaccelerates, but then you have to consider the other 66% of services, which we think is either growing robustly at, call it mid-teens to high teens, or the relationship with Google, kind of the Google TAC digital advertising business, which we see rebounding in the back half of the year.
I mean, you have it as your number one hardware play at a time where we're talking about a slowdown in consumer electronics, generally speaking. Is Apple immune to that or not?
I'd say they're more immune. Of course, they're not fully immune. If you look at what Apple reported for the December quarter, for example, where the wearables business down 7% year over year, despite launching a new Apple Watch, a new Apple Watch Ultra, new AirPods. That shows that Apple is not fully immune. But you have to remember, there's 1.2 billion people in this world that own an iPhone. I would call that the technology product that largely controls their world. That, to me, is a staple. I'd argue the iPad and the Mac are a level below that. And so are they fully immune? No. Are they more immune than others? Yes. And just one data point I'd throw out there. In calendar 22, Apple revenue grew roughly 4% year over year. The rest of my consumer hardware coverage, the median revenue declined 6%. To me, that shows that Apple is more immune than the large majority of the consumer hardware universe.
What about speculation around a hardware subscription service? And I want to make sure that I read this correctly in the note. Do you think that that can really unlock an additional $1 trillion in potential market cap for already what is the largest company by market cap?
Scott, I'm happy you asked me. That is what gets me excited as an Apple analyst today. Remember, if we think maybe 5 years back, Apple was viewed as a cyclical hardware company. I think what we've learned over the last 5 years is that having a services business that's $70 to $80 billion, represents more than 30% of gross profit dollars, ultimately makes it more like a platform, not necessarily a cyclical hardware company. I think the shift to subscription is the next evolution of this model. Really why that's important is because it gives consumers and analysts better visibility into cash flow generation, more stability in financials. And when you look at peers, whether they're Staples peers, streaming services, software subscription companies, they all trade at a premium to where Apple trades at today, roughly 22 times our fiscal 24 EPS. So my argument is, when you put on the lens of, hey, Apple is more of a subscription company than it is a cyclical hardware company, that actually can unlock value. We'd size it at about $1 trillion of market cap. For me, that's my bull case. That's about $235, my bull case valuation. That incorporates the shift to subscription, or at least the market viewing Apple from the subscription lens.
Wow. I mean, I'm just looking at it now and thinking about, $3.3 trillion in market cap. I'm wondering also how you think about China, given the reopen and these stories, even a new one today, suggesting that suppliers for Apple are, in the report's words, rushing to leave China.
So China is obviously a very important market for Apple. On the supply side, obviously it's the core of Apple's manufacturing base. That won't necessarily change, but we are seeing a shift on the margin to to countries like India, like Vietnam, like Malaysia. I think that will continue. Again, diversification from your manufacturing base, especially after what we saw in the December quarter, to me is the smart thing to do. Then you think about the demand side of things. China is in the process of reopening. It's Apple's second largest market from a demand perspective. China open is better than China closed, right? The one factor here that I would say, maybe where I differ a bit, is I actually think that China is probably more of a tailwind. The pent-up demand in China is more of a tailwind when we get further out into the year, simply because China is a very aspirational market. The Apple brand is a status symbol. I think that Chinese consumers are going to wait, call it 5 to 7 months, to get an iPhone 15, a brand new iPhone 15, rather than buying a 4 to 5 month old iPhone 14 Pro. So we'll see how that thesis plays out over the next few months. But again, China open, much better than China closed. Second largest app store market as well. So China is obviously very key, again, to unlocking pent-up demand, both on the product side and on the services side.
Let's get to the buzzword of the moment. And I know you know where I'm leading that to, and that's AI, right? It feels like we're talking about everybody but Apple when it comes to this, right? Whether it's NVIDIA or Microsoft and Alphabet, et cetera, and the names of the biggest players out there who get talked about the most. What about this one? What about Apple? And how does that all factor into how you view the next several years for this company and the stock?
Listen, I think if you're a company today in the technology landscape and you're not thinking about artificial intelligence, there's a chance you get left behind. Ultimately, we know that Apple has a number of different artificial intelligence capabilities. They launched their core machine learning product or APIs in 2017. I think that Apple is still very much working on AI, but they are not at the same level of Microsoft and ChatGPT. They're not supplying the GPUs to the hyperscalers like NVIDIA is. And if you think back in time, Apple hasn't always been the first to technology in new markets, right? If you think about 5G, they weren't first. Quad cams, they weren't first. Flip phones, they weren't first. I think Apple is watching the market develop and understanding where they can use their expertise to monetize AI. Where I think that ultimately happens is edge compute. Remember, Apple is the only vertically integrated smartphone vendor that is major in the markets today. They optimize their software, their hardware, and their services together, completely vertically integrated. So when there are applications that come out that require compute on your iPhone, the iPhone is a much better and more sophisticated and powerful and more efficient product than other smartphones. So I do think eventually AI becomes a product that Apple can better monetize, but I think it's a crawl, walk, run, and Apple is evaluating the market today to understand where they should pounce ultimately to monetize it.
Speaking of pouncing, but before I let you go, this idea of whether Tim Cook will ever do a monumental acquisition, and who knows what that might be, but they've sat on this mountain of cash for such a long period of time. I just wonder how you think about what he wants to leave his legacy and mark on this company beyond, an amazing installed base and all of the other stuff that we always talk about. In a dislocated market, which you certainly have in some parts of this market, does he use the opportunity to, in your word, pounce on something, a big fish that's just too good to pass up?
I think you cannot rule Apple out of that opportunity. But I do think recent history shows that Apple is more adept to building than buying. We've talked about these rumors of what Apple could buy for many years now, and ultimately what we learn is that Apple has had internal initiatives to develop those products, whether it's smart speakers, whether it's, again, AR, VR glasses, obviously video and TV Plus is another one. So I don't think we could rule Apple out of the running. But I do think that today Apple's kind of capital allocation priorities are obviously reinvesting in the business, returning $80 billion of cash to shareholders. That's good too. Paying a dividend. And listen, if there's something opportunistic that Apple can do that's actually transformational, I'm sure they're evaluating it. They'll continue to do tuck-ins. That won't cease. But I do think that Apple sets a very, very high bar when it comes to doing something transformational. Valuation isn't the only factor here, but I would venture to guess with probably a high degree of confidence, Apple's out there evaluating all of the opportunities.
Yeah, I'm sure they are. It's been a pleasure. I appreciate you coming on Closing Bell with us, Erik. We'll see you soon.
Thank you so much, Scott.